With us, Managing Director at Kotak Mahindra Asset Management Company. Nilesh, great day to speak with you. It's always great to speak with you, but today it's special because we are back at new highs after spending just a few days dithering and maybe a little sideways. You've got political clarity. You've got this clarity now coming from the Fed itself that maybe the highs and rates are done and 2024 perhaps will start cutting. So they were very clear about that. Where does it leave us? It's almost too good to be true, but it is true. Go on, Nilesh.
So there are various ways of describing this, Prashant bhai. One, as a kid, I'm sure you would have watched a movie called Drunken Master by Jackie Chan. The Fed is the guru of Drunken Master. They are earlier saying transient inflation, then say rates higher for longer. Then they say we will not hold it more than needed. Every move of the Fed was trying to create confusion in the market. And maybe he was the guru of Drunken Master, trying to keep market confused and actually achieving what they wanted to achieve. I think credit should go to US Fed for maintaining a very, very delicate, fine balancing between growth and inflation. That does inspire confidence in the markets on US Fed. The second way to look at Prashant bhai is that the god seems to be Indian. We were worried about US interest rate rising. Santa Powell comes out. We were worried about oil going to triple digit thanks to geopolitical tension. God plays his role and tathastu, oil is down to 75. We were worried about monsoon and, while the August rains were bad, September recovery happened. We were worried about central election and the state election results give an indication. So now you have to believe that God is an Indian, stay invested in the market, enjoy the ride. But at the same time, as Nigel was mentioning, 50,000 becoming 50,000 in a very, very short period of time. I mean, that's not real. That is dream.
Yeah. People shouldn't get used to it, right? That disclaimer is something you want to put. But, Nilesh, I must say, if I can say so myself, that you are a lucky charm for the markets. Every time the market hits a new high, you're here sitting in front of us, talking about the market. So thanks for that. But I want to talk about how, if you believe this is India's sort of 401k moment, right? Because we are now seeing higher financialization of savings as well, something that we haven't seen happen in the last decade. Do you think we could de-risk from this whole foreign investments that we keep talking about? And do you think the next leg, the next expansion, the next leg of this rally will purely be led by domestic money?
Undoubtedly, Sonia. We have seen now about 7 crore folios investing in SIP. We have seen tremendous maturity of retail investors thanks to the works done by regulator, mutual fund, and our partner, the mutual fund distributors, which ensures that if there is a correction, there is more money flowing in. So whichever way we look at it, from a maturity point of view, from a flow point of view, from a momentum point of view, domestic investors will continue to play an important role in our market. And that has resulted into a significant thing, which is reduction in India's risk premium. Few years back, we were about 1.4 times more volatile than emerging market peers. Today, we are 60%, 0.6%, 0.6 times that, 60% of that. This hopefully should result into lower risk premium for India, and that might mean higher valuation can be justified.
Hi, Nilesh. Good morning. As I mentioned last week when we met, Nilesh, 15 to 50, I'm investing in my SIPs. I'm telling my kids the next 15 years will be super for the market, and they will, enjoy the fruits of what we are putting in today by keeping our SIPs going. So I'm keeping the faith in the markets. But, what about, for 2024 itself? This year has belonged to the mid and the small caps. At current reckoning, do you think that a higher amount of allocation should be to the large cap names? Because out there you have valuation support as well. And if the money is coming in, that maybe higher allocation out there would make sense?
Undoubtedly, yes, Nigel. Couple of things to support apart from valuation will be fund flow. As US Fed starts coming down, and US equity markets relative to emerging market looks on the higher side, flows will begin on emerging market, including India. I was only looking at data today. On a 10-year basis, there are markets like China and Brazil and Russia and South Africa, which have given 1/2, 1/3, or negative returns compared to India. It's likely that India will be the biggest beneficiary of emerging market flows. And all these global investors ideally will more come towards large cap, which hasn't moved, which looks cheaper from a valuation point of view, and where there is liquidity. So overall, I see large caps closing the gap with small and mid caps in 2024. One more important point which we should remember today, there is a fairly large arbitrage funds, about 150,000 crore rounded off, which provide money to HNIs to, take on any selling or build long positions, leveraged positions. So between the domestic institutional investors and even a product like arbitrage fund, which equips HNI to build leverage long positions at a very, very competitive rate, the domestic investors' influence on the market is increasing.
Yeah, no, absolutely. Nilesh, let me ask you to comment on that phenomenon. I mean, I'm using only IREDA as an example. Actually, I was looking at, we get this data about what mutual funds bought and sold as a category every month. And a lot of mutual funds actually bought, I don't have the exact numbers, I think by about 750 crores worth of IREDA in November. But what do you make of the rise? And as you said, you kind of gave us a hint that obviously it can't be real. I mean, so just talk to us about that and some of the pockets of irrational exuberance, if you can call it that, Nilesh. And it's important to alert viewers, towards those points as well. Go on.
So, Prashant, you have correctly mentioned that there is a pocket in the market where there is irrational exuberance. One is the SME IPOs. Clearly, we are seeing far amount of money chasing stocks over there and valuation going out of whack. At this valuations to invest in these companies, they'll have to be like the team of Marvel superheroes doing incredible things to give return to the shareholders. Now, we do know that Marvel superheroes exist in comic and not in real life. The second thing is what I will call limited floating stock or controlled floating stock counters. There are PSUs where 95% is owned by government and 5% is with public. There are defense and railway companies where 80-85% is with the government and 15-20% is with public. Now, in this kind of counters, float is controlled in the few hands. They are all reluctant sellers. They are creating an illusion where a little bit of buying is resulting into valuation going beyond what normally should be. They are like, the USS Enterprise Star Trek serial Captain Kirk to boldly go where no man has gone before. Now, when you invest in those valuations, do remember that post-election government will do divestment. There will be supply in these counters. And at this valuation, they are unlikely to find many buyers. So there is a pocket of irrational exuberance in small caps, in limited floating stock counters, in SME exchange kind of IPOs, where one has to be careful.
Okay. Actually, I just wanted to take that IREDA discussion forward because, the government has set a very ambitious target, right? They have this 500 gigawatt of renewable energy capacity by 2030. So they are going all in this renewable energy sector. For someone, Nilesh, who has perhaps missed out on this rally entirely, not just in IREDA, maybe in something like an Inox Wind, Tata Power, JSW Energy, all the guys that are participating in this renewable energy boom, do you think it's too late or is there still scope on the upside?
So, Sonia, it's always difficult to say when the momentum will end. But let's remember that before Ukraine war, coal and thermal power or nuclear were non-ESG. When the push came to shove, the ESG definition was changed. Nuclear became acceptable, thermal became acceptable. So while undoubtedly, thanks to global warming, there will be focus on renewable energy, but there will be compromises, like at the time of Ukraine, like in COP26, COP28 right now. In Dubai, the fossil fuel producing countries forced a compromise on the conference. So there will be ups and downs in renewable energy. And hence, while you want to invest into a trend like technology, like generic medical, like chemical sector, be aware that even in those long-term trends, there will be massive correction.
Okay, all right. And Nilesh, it was great speaking with you, and hopefully the next time we meet, the market will be at another fresh high, because you are a certified lucky charm for the market. Every time you come on board, markets are a new high. So thank you so much for joining us.